here from Success with Options. This is a third video of a three-part series on diagonal spreads. In the first video, I provided an overview of diagonal spreads using slides. In the second video, I actually showed an example of doing trade analysis and trade entry of a diagonal spread. In this particular video, I want to go over trade management and trade exit of the diagonal spread. So with that, let's go ahead and get started. What I've done is I went ahead and jumped forward a couple of days from our initial trade entry. This is currently the 5th of March, and what we see already is that when we entered the trade back here on the 2nd of March, we were just flirting with breaking through that resistance level. And we've seen after a few days of trading that we've actually managed to bust through that. So now that's the second level that we've broken through. The first right here and the second right up in this area right here. So we're quickly pushing up and heading towards our short strike, which is currently a March quarterly 66 call. So what we're going to see as time goes on is this thing is going to continue to push forward. Let's go ahead and jump forward a little bit. First of all, I want to jump over and look at our trade. We can see that just after a couple of days of allowing this trade to develop, we see that we're already in a little bit of profit, and that's just largely from the move up of the underlying IWM. We're going to go ahead and jump forward to the end of the day and take a look at the chart we have here. And we see that after the end of the day, we've actually punched all the way through 66, which is our short call. So now we're fully in the money on this particular trade. Let's jump forward even a little more in time. Okay, we've jumped forward in time to the 22nd, and we've seen that we've had a nice little run up here. And we've pushed past the point where we broke through before. We've reached all the way up. We've had a bit of a sell-off, and now we're starting to see a resumption of the rally. And now might be a good time to perform a roll on this trade. What I can do is I can take a look at this particular position. We see that we have about 9 days left on this position, and it's a good time to consider doing the roll. And we also see that the trade has also built $123 worth of equity in the trade if I was to just close the trade altogether. What I'll go ahead and do is create a rolling order, roll that position, and we're looking at about 51 cents. That's a pretty good price, and I think I'm going to go ahead and go with that particular value. It's not as much as we originally hoped. I think we'd initially calculated a 70-cent roll, but remember that we're rolling from a quarterly. It's not a full month roll from month to month, so we're running on a little bit less time on this particular roll. So we'll go ahead and execute this trade. We'll do a confirm and send, and we've now rolled that position. So now what we're looking at is a April 66, May 59 call. Let's now move forward a little farther in time. Let's go to the 1st of April. And we see that after all of that time, we've had a bit of a rally up, but we're pretty much running sideways at this point. But that's okay. At this point, our short strike is still an April 66 call. Our long strike is a May 59 way down here. So we're doing pretty good on this trade. We're actually looking quite good. Let's go ahead and jump forward a little farther. Before we do, just notice that our profit and loss has improved even more. The last time we looked at this position, it was about $123, but remember, we've done a roll which allowed us to pick up some extra premium, and we've moved forward in time, which has caused the short strike to lose a little bit of value. We're going to go ahead and move forward to the 5th of April. And we're looking pretty good here. We are about 2 weeks away from April expiration, and we want to consider a possible roll on this trade. And what we're going to do is we're going to roll it into some form of vertical spread because remember we still have that long 59 in May, and if we roll directly across our 66, our short 66, we would basically have a long vertical spread in May that would be a 59.66 call spread, which is still a $7 wide spread. The thing that we want to consider is whether or not there would be any benefit to us in rolling not just out to May but also up to 67 since we've got such a strong move. So we're going to look at both options and consider what we might want to do. First, let's take a look at what happens if we roll directly across. And we see that the 66 call, the roll from the April 66 to the May 66, results in somewhere between 78 and 82 cents in credit. Let's go ahead and consider rolling to the May 67 and see what we have. And here we see that we could get about 11 cents worth of premium on that roll. That would be 11-cent credit. So let's just step back and think about what we're looking at here. Our two choices are that we could roll forward directly across to the May 66 and pick up 80 cents in credit. The other option is that we could roll up an extra dollar and add a dollar to the width of the spread and pick up an extra 10 cents. Okay, so if we were to take the first option and just roll directly across to the 66, we'd pick up the 80 cents, and if we add that to the 51 cents and subtract from the initial debit of $5.76, we'd be looking at about a net debit of 4.45, and with a spread of $7, we'd be looking at a profit about $2.55. The other option is we're looking at taking a 10-cent credit but allowing us to roll up to an $8 wide spread. Now if we take a 10-cent credit, that would make our net debit in the trade $5.15, but we'd have that extra dollar, and so that would actually give us a $2.85 credit, a net profit. So it looks like rolling out would be the more lucrative option. So that's what I'm going to go ahead and do on this particular trade, is I'm going to roll for the 11 cents. And now if we go back and look at this trade, we see that we have a position that is a May 59.67 long call spread. And now we're ready to just wait until more time expires and we go ahead and take our final exit. Now the thing is that we know we're not going to be able to get the full amount of this spread, and the simple reason is that in order to do so we'd have to wait all the way to till expiration, which could be a pretty risky proposition, and generally we can get the majority of that move without waiting. So what we're going to do is look for a time in the future when we can get an optimum amount out of this trade. Alright, we've moved forward to the 29th of April. We're getting pretty close to the last expiration period, and it's time to start looking at possible exits. We've seen a pretty good run from down where we were before. We pushed up above 70, we pulled back a little bit, we pulled all the way up to 74, we've had another pullback, and then yet a small rally here. So we're pretty deep in the money. We've got a long 67, we've got a short 67 and a long 59, and we're quite a ways in the money. We're like another $4 or $5 in the money. So it's probably time to consider whether or not we should exit this trade. So let's go ahead and go back to the trade tab, and let's actually look at the monitor tab. And right now we could sell this spread for $7.82. So let's go ahead and set that trade up. We have an $8 wide spread that we can close for $7.82. The question is, should we hang on for that last 20 cents? I say no. I think to get the last 20 cents is going to have to take us all the way to expiration, and I think the wise thing to do would be to go ahead and take an exit right here. So we're going to go ahead and exit this trade, and we are completely out. And we'll see when we do the analysis that we didn't quite make the full amount that we'd originally planned in the 285. We closed that last roll not for $8 but for $7.82. Okay, we took in $7.82 in credit, but we paid $5.76 to get into the trade. That leaves us with a net of $2.06, but we took 51 cents in the first roll and 10 cents in the second roll, which leaves us with $2.67 in final credit. Now that's $2.67 of net profit with a $5.76 initial debit, which means we received a 46% return on our investment for about 2 months worth of trade. Okay, this has been a diagonal spread trade from beginning to end. I hope you enjoyed the video and I hope you found it valuable. I wish you successful trading. Bye.